All right, folks, imagine being handed the keys to your dream home and realizing you don't need a calculator to make sense of the loan terms, almost like a fairy tale, right?
Well, perhaps enchanted math isn't the first thing that comes to mind, but there's no denying that understanding conventional mortgages is key to unlocking that door.
Oh, Ralph, always the beacon of practical wisdom. But let's break it down. The article we were discussing tells us that 77% of mortgages in 2023 were these so-called conventional loans. It's the bread and butter of home financing.
Exactly, Aria. Conventional loans aren't insured by the government, but they are pretty popular because they come with a lot of flexibility. You see, these loans can either be conforming or non-conforming. Conforming meaning they follow guidelines set by Fannie Mae and Freddie Mac, our friendly neighborhood government-sponsored entities.
Friendly neighborhood GSEs? How reassuring. It sounds like a Marvel comic, but without the spandex. Fannie and Freddie essentially keep the mortgage world spinning by buying these loans from lenders, which in turn provides liquidity to the economy, right?
Precisely. And let's not forget non-conforming loans. They usually allow bigger loan amounts and some shy away from the cookie cutter borrower profile, which can be appealing to those with unique financial circumstances.
So basically, if your credit history isn't textbook perfect or your dream home is more of a sprawling agrarian idyll than a cookie cutter condo, a non-conforming loan might just save the day.
However, conventional loans generally require a solid credit score and a reasonable debt-to-income ratio. In return, they often offer better rates and terms, provided you stay away from the seductive trap of putting down less than 20%, which would saddle you with private mortgage insurance.
Ah, PMI, the joy of paying extra for the privilege of paying less upfront. But it's not all doom and gloom. Remember, folks, you can cancel PMI once your home equity hits that 20% sweet spot.
Oh, indeed, there's always a silver lining, but let's also consider how jumbo loans, which exceed the conforming loan limits, require heftier down payments and stronger borrower profiles. They can sound intimidating, but are essential for those in high-cost markets.
In the grand tapestry of mortgages, it seems like the key differentiator is the balance between risk and reward. Choose your own adventure.